Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're diving into the financial report of the Greater Cannabis Company, and let me tell you, it's a bit of a roller coaster. I mean, a company with cannabis in the name not making any money sounds like a joke, but it's their reality. We're looking at their annual report, a Form 10-K for the year 2024. This is where they lay out all the details about their business performance and any potential risks. Think of it as a corporate tell-all, but with less juicy gossip and more numbers. So, who is the Greater Cannabis Company? They were formed back in 2014, went through some changes, and are now focused on developing cannabinoid therapeutics. Basically, they're trying to create medicines using compounds found in cannabis. They've got a license agreement to develop therapies for things like autism and Alzheimer's. The cannabis space is crowded. They're up against some serious competition from the big pharmaceutical companies like Jazz Pharmaceuticals and Zynoba Pharmaceuticals, who have way more resources. One of the biggest hurdles is government regulation. Cannabis is still illegal at the federal level, even though many states have legalized it. This creates a lot of uncertainty for companies in this industry. They may need FDA approval to market their products, which costs a lot of money and time. Alright, time to look at the numbers. This is where it gets interesting. Let's jump to their balance sheet. First, cash, they have about $57,000. That's not a lot to run a company, especially one that is trying to develop new drugs. It's actually down from about $166,000 the previous year, so they are burning through cash quickly. Then there's the right of first refusal agreement, worth only $417. Last year it was a little over $5,000, so this is being amortized or written off since its value is depreciating fast. This agreement gives them the first shot at getting involved in certain business deals, but if it's worth so little, they may not be exercising it or doing anything valuable with it. Looking at the other side, they owe about $898,000, so their debts are way higher than what they have in cash and other assets. Ouch. They had zero in product sales in both 2024 and 2023. Meanwhile, expenses around $156,000. So with no income and lots of expenses, they had a net loss. What a surprise. About $179,000 for the year. They lost almost $20,000 less this year than last year. So that's something. The cash flow statement tells us how money is moving in and out of the company. They used about $109,000 in operating activities. This means they're spending more than they're bringing in, which is why their cash balance is going down. The final cash balance is about $57,000 again, not enough to sustain their cash outflow. The accountants are worried. They say there's substantial doubt about the company's ability to continue as a going concern. This is accounting speak for they might not be around much longer. They mention the losses, the lack of cash, and the high debts as reasons for concern. The company is hoping to secure additional funding, but there's no guarantee. These are basically loans. They have to pay a certain amount to a third party. The biggest loan is a convertible promissory note. This means the lender can convert the debt into stock. The audit was done by Amolo and Partners, a public company accounting oversight board, registered accounting firm, and even they said they have substantial doubt about the company's ability to continue. Not a good sign when your own auditor is having doubts. Now let's talk about the ownership structure because it's a bit complicated. The Series A convertible preferred stock, the big shareholders of this company own it, and that one share can be converted into 50 shares of common stock. The report warns that these financial statements assume the company will continue operating. However, assets and debts could be way off. Basically, it is a warning to investors to take these results with a grain of salt. It's also worth mentioning that they've had no changes in management or acquisitions. The company admits its disclosure controls and procedures weren't effective. It means they didn't have a good system in place to ensure information was accurate and timely. They also say that their internal control over financial reporting wasn't effective. This is a big deal. Internal controls are the processes a company uses to ensure its financial statements are reliable. The company admits it has material weaknesses in its controls. This means there are significant problems that could lead to errors in their financial reporting. They do have an outside accounting consultant making sure their statements are prepared in line with regulation. The company includes a section about forward-looking statements and risk factors in their annual report, and one of them to prevent the growing of cannabis on public lands and the attendant public safety and environmental dangers posed by cannabis production on public lands. That is pretty interesting. What's our take on the Greater Cannabis Company? Well, the numbers don't lie, they're burning cash. They have little to no revenue, and their accountants are worried about their ability to stay afloat. They're making some pretty big promises and claims about all of the science, but these are not backed up by any income at all. This could be a very risky investment. The potential for developing new cannabinoid therapeutics is there, but they need to find a way to bring in revenue and stop losing money. Securing funding is critical, but it's not a sure thing. The numbers simply aren't there. Without a serious change, of course, it's difficult to see the greater cannabis company becoming a major player in the pharmaceutical market. Their debt levels are worrying, with extremely low cash levels and a bleak financial picture. The road ahead looks tough, and thanks for watching. If you enjoyed, please subscribe, like and comment.